Understanding pennant chart patterns in technical analysis. In the realm of technical analysis, deciphering price movements and patterns can greatly enhance trading strategies. One prominent chart pattern that traders often focus on is the pennant. This article delves into the intricacies of pennants, their formation, significance, and how to effectively trade them while mitigating risks. What is a pennant? A pennant is categorized as a continuation pattern, which suggests that a security's current trend will resume after a brief period of consolidation. The formation typically starts with a strong price movement, known as the flagpole, followed by a period of consolidation that forms two converging trend lines, the actual pennant. After this period, a breakout occurs in the same direction as the initial price movement, thereby extending the flagpole. Key takeaways. Volume matters. Recognition of volume dynamics is crucial. The initial move should coincide with high volume, whereas the consolidation phase typically occurs on lower volume. A breakout is then expected to happen on considerably higher volume, validating the pattern. Confirmation techniques. Traders often combine the pennant pattern with other indicators or chart patterns for stronger confirmation before making a trade decision. Understanding the structure of pennants. Pennants can be visually similar to flags, but they exhibit a distinctive structure. The consolidation phase of a pennant lasts between 1 to 3 weeks, forming a symmetrical triangular shape due to converging trendlines. These trendlines establish a mini-price range, and traders monitor the movement toward either the upper or lower trend line for potential breakouts. Here's how a typical pennant formation looks on a price chart. Pennant formation, https://www.nvstope_diameter.com/thmb/kc_YGAQBNXVVOSUGAF_ego/x/filters no_upscale%c progressive%c/native /pennant formation AVE. In this chart, the flagpole symbolizes the preceding upward or downward trend, while the pennant forms as a period of consolidation. Traders are particularly keen to watch for breakouts from the upper trend line in a bullish pennant. Trading strategies involving pennants. As a trader identifies a pennant formation, they typically consider placing trades just beyond the breakout point. For instance, if a bullish pennant is detected, a trader may set a limit buy order slightly above the upper trend line. They often look for confirmation through increased volume to validate their trading decision. Price target concept. To calculate the price target for a pennant, the trader adds the height of the initial flagpole, from the lowest point to the peak before consolidation, to the breakout point. For example, if a stock surged from $5 to $10, and the breakout occurs at $9, traders might anticipate a target price of $14, $5 plus $9. Implementing stop-loss orders. Effective risk management involves setting stop-loss orders at the lowest point of the pennant's formation. If the price drops below this level, it may indicate a potential reversal and the failure of the pennant. Limitations and risks associated with pennant patterns. Despite their popularity, pennant patterns are not foolproof. Several key limitations need to be addressed. Impatience and premature entries. Traders may jump in too early during the consolidation phase, risking false breakout entries that can lead to losses. Neglecting broader market context. While focusing on the pennant formation, external economic factors can influence price movements, potentially invalidating the technical setup. Inadequate risk management. Failure to set appropriate stop-loss orders may expose traders to excessive risk. Failed pennant formations. Pennants can fail for various reasons. Lack of volume confirmation. Insufficient trading volume during the formation may suggest weak market interest and increase the likelihood of a failed breakout. External events. Unexpected news or economic data can alter market sentiment rapidly, overriding patterns initiated by technical analysis. The psychology behind pennant formations. Understanding the psychological dynamics surrounding pennant patterns can enhance trading accuracy. The consolidation phase reflects a struggle between bulls and bears, with market participants indecisively weighing their positions. This indecision creates a temporary equilibrium, making traders alert to potential breakout opportunities. Distinguishing pennants from flags. While pennants and flags may appear similar, they possess distinct differences. Pennants, characterized by converging trendlines creating a triangular shape. They suggest a brief period of indecision before a potential trend continuation. Flags feature parallel trendlines forming a rectangular shape. Flags typically show a price retracement against the prevailing trend. Recognizing these differences is crucial for effective technical analysis and accurate trade placement. Bullish versus bearish pennants. Bullish pennants appear after an uptrend and indicate a potential upward continuation. Bearish pennants form after a downtrend, suggesting a continuation of the downward price movement. Conclusion. In summary, pennant formations are a valuable tool in a trader's arsenal, representing short-term continuation patterns that can significantly influence trading strategies. By understanding their characteristics, managing risk effectively, and confirming signals through volume and other indicators, traders can adeptly navigate the complexities of market dynamics and capitalize on trade opportunities presented through pennant formations. It's crucial, however, to remain aware of the impact of broader market shifts, as they can drastically affect the expected outcomes from such patterns.